Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest news, happenings, rumors into what's going on with the residential lending industry. Each week, I am pleased to have one of our lender members as my co-host. And this week, a longtime friend and acquaintance, the EVP of Mortgage Banking for WesBanco, Ed Hensley. Ed, thanks for joining me.
Oh, Rich, my pleasure. Thanks for having me.
Awesome. So before we get started, Ed, I always like to let our co-hosts set the table a little bit. Tell us a little bit about WesBanco and the mortgage lending operation within it.
Rich, we're what would be called a small regional bank where we've passed the community bank standards. We're headquartered in beautiful Wheeling, West Virginia, but we have offices on the East Coast of Maryland, Northern Virginia, Western Pennsylvania, all West Virginia, Ohio, Kentucky, and part of Indiana. So really, we've really started concentrating on mortgage in about the last 4.5 years. We've grown it into over $1 billion, heading to $2 billion here probably this year in production. We've been an acquirer of banks. We've expanded our footprint. We ranked as one of the best banks in America by the Forbes survey. I think you've actually put that out to some of the members, along with some of the other members of the co-op. So yeah, we're very proud of that. We pride ourselves on customer service and being members of the community.
Awesome. And as always, no shortage of topics to discuss this week. So let's go ahead and get right into it. And as always, strive for interactivity in the program. Any questions, comments, thoughts anyone has on anything Ed and I are discussing, or you want to hear us discuss, please feel free to type it into the chat or the Q&A, and we'll go ahead and incorporate it into the program. So, Ed, let's start with this week. Kudos to MBA, really, for having their ear to the ground here. Infrastructure spending, other bills going through Congress. I guess some murmurs and whisperings that in the quest to fund some of these things, that one of the things being bandied about inside the walls of Congress was a G fee increase, another G fee increase, and using American home buyers as a piggy bank to fund infrastructure spending. MBA and about like 19 other groups that signed on to the letter sent a pretty sternly worded note to some members of Congress, basically laying out all the reasons why this would just be an awful idea. But any thoughts on just G fees in general and the whole, the history of, we can get into that a little bit if we want to, the history of G fees and how that works. But your thoughts there, Ed?
Well, I think what's scary about it, Rich, is that it had bipartisan support. I mean, there were a couple of prominent congressmen that actually proposed that, one from Ohio. I think Portland was on board. So it wasn't a Republican initiative. It wasn't a Democratic initiative. It was kind of both saying, hey, how are we going to pay for some of this? Obviously, the infrastructure bill is extremely important. I think they look at, the agencies as a source of income. Kudos to the NBA and the other groups that are fighting it. They put a temporary fee in a few years ago, as you'll recall, that fee's still in there. This would increase the cost of home ownership or refinancing to every borrower. So it's something that as a group we have to be kind of vocal about and keep our eye on it and see what happens. It's been relatively quiet the last a couple of days after I think the letters went out, but I'm sure there's a lot of lobbying going on behind the scenes, and something we'll definitely keep an eye on. I would personally rank the probability at 50-50. I think when depends really on where they're going to get the money to pay for some of this. And if they get a lot of backlash, I think they'll back off. But if not, they'll steamroll it through. So it's something that, again, we have to really keep our eye on.
Oh, absolutely. It's like MBA, they're advocating on behalf of so many different types of mortgage lenders, big banks, community banks, credit unions, big and small, independent mortgage banking companies. And I know that is a delicate balance, that we have members that would like to see them spend more time maybe advocating for this or not advocating for that. The bottom line, though, is our industry, and you know me, I'm no shill. I tell it how it is. We need somebody with a voice in Washington because our industry gets walked all over. I mean, we heard it last year. Oh, mortgage bankers making so much money. Nobody, it's such a critical part to residential finance, our economy in general, how we fund residential homes in America and the financing of them. And politicians, they don't love the mortgage industry.
No, and Rich, I think, we went through a period where regulation had kind of backed off. And as some of your guests have said in the past, I think regulation is going to be one of the key things that we as an industry are going to face. And it doesn't, I don't think it matters if you're a bank, a credit union, a small IMB or a large IMB. I think we've all got a vested stake in that. There's going to be some targeted enforcements, as you said, that don't look favorable on our industry. But we serve a vital purpose to the whole economy and the American population.
It's going to be a interesting dance. The Biden administration and that has now come in. So much talk about affordable housing initiatives and creating an even playing field for people who want to purchase a home in America. At the same time, on the regulatory side, certainly things getting ramped up there with the new leadership at the CFPB and some of the other things that have been bandied about. So it'll be very interesting to keep an eye on to see how this all progresses and trying to kind of serve both masters there to make home ownership available to more people, yet to not be overly penal to the community lending institutions that are doing a lot of that lending, like banks like WesBanco.
Exactly.
Moving on to some other news in the headlines. Existing home sales, something we've been keeping an eye on this program, been chronicling its decline 3 months in a row from March to April to May. Now, finally, and normally we don't see that, obviously, in our industry. We typically see existing home sales go up as we get into the spring and the summer. Finally, a tick up as we got into June, up 1.4% existing home sales from May to June. Interesting of note in that report, the median U.S. home price, a record high, $363,000, up 23.4% from a year ago. The average home sale price in America, almost surreal that I just read that statement. What a crazy last year it's been for the mortgage industry and housing in general.
It has, Rich. Supply has obviously been the biggest talk on the LO side besides refis. What we have seen over the last couple of weeks, I've seen it in the Ohio market, the Kentucky market, as well as Maryland. Listings are up. After the fourth happened, they seem to have more. There's more of a supply. As you said, the prices are still going up, but there's optimism on the realtor side that they're starting to see some light at the end of the tunnel. I had also read a few things over one of the markets where, as opposed to a house going up and being sold in the first day, it might be up 3-4 days a week. It's kind of leveled out with the multiple offers. So something, again, we'll have to kind of keep an eye on. The over ask price and all the waivers and things that we've seen and you've heard about kind of got some bad press, and I think that backed a few people off that to some degree. And I think some people waited till after school was out and some of the COVID mandates got lifted, and we have seen, as I said, an increase in some of the markets. It's, again, a trend that we want to keep an eye on and see how that goes.
Yeah, inventory, another item of note in that report, housing inventory in general up 3.3% in June versus May. So to your point, starting to see some relief on the supply side. That said, something I've just talked with others about, and we were on a team call this morning, and our wonderful head of marketing, Gabriela Mendocino, is 25 years old. We're just having a team call this morning and made a comment like every one of my friends is like a millennial that's waiting for the housing market to cool down so they can buy a house. So I feel like there is this suppressed demand that is lingering out there, especially I think amongst a lot of young people that, to your point, all the news and reports of 30 over offers over asking and waiving this and waiving that and these crazy offers that just said, listen, I'm going to chill out for a little bit and let's take a look at things maybe after summer and in fall. So I think it's going to be just no matter, even if inventory keeps going up, I think it's going to be gobbled up and there's going to be a lot of demand lingering.
And Rich, kind of a point to that, what we saw, we refer to it as buyer fatigue. We saw a lot of our pre-approvals get discouraged after 2, 3, 4, 5 offers not getting it. We had several people say, you know what, we're going to wait. We're going to wait till the fall. We're going to wait till the spring. We just re-upped our lease 6 months, a year, or whatever. And also, I've read some national articles that the millennial population is ready to buy. So I don't think it's going to cool down that much. I think that it's a supply-demand factor. There's a lot of variables, but buyer fatigue played into it, and people did back off, but they will come back. as interest rates remain kind of in a narrow range here, I don't think that's going to scare people away.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by WesBanco's EVP over mortgage lending, Ed Hensley. Ed, got to touch on, this was broke just before last week's program, but the adverse market fee, FHFA, kills it. Nothing but cheers all around there. Basically reduces the interest rate for people that want to refinance by about an eighth. Just from talking to some members, not like seeing huge waves of refis pouring in after this, but on the margins really helps, right? For that borderline, does refi make sense or not, homeowner?
It does, Rich. And it was kind of interesting. Obviously, when that was announced, it was deliveries after August 1st to the agency. So we took it out, the next day. And, immediately we got to jump in our applications. I think it was some of that pent up demand. I kind of referred to it with our sales staff. Hey, you have an opportunity. You've had people on the fence or they're thinking about it or whatever. You just gained 50 basis points. Take advantage of it. So we saw initial, I'll call it bump up in applications. It's definitely considered a positive to the market. The LOs are talking to their databases, et cetera. I'm glad it happened. It needed to happen. It was supposed to be for COVID-related expenses, and the agencies haven't had that to the degree they thought they were. So that was good news for our industry all around.
Yeah, I think that just in general, and you'd know better than me, I've been out of the game as a lender for some years now, but the tools and resources that loan originators have at their disposal, if it's, some of these newfangled CRMs and other tools where they, for their book of past clients know, like, hey, gets down to 2.7, it makes sense for this group of people. It's that's another, I think, advantage that originators have today that maybe they didn't have as much 10 years ago, right?
Yeah, we're back. As you said, Rich, back when you and I were probably doing more of the actual lending. Sometimes you needed a half point to a full point to say it justifies refinancing. You don't need that today. It can be an eighth, it can be a quarter, depending on the loan amount, the cost, and things along those lines. So, kind of an interesting side note to that is a lot of lenders are experiencing portfolio runoff. If you've got arms in the servicing portfolio, whatever, even though we're having, as an industry, record-breaking production. Runoff is happening because people are going to the secure fixed rates, and that affects us as a bank. But I also sit on the board of a nonprofit who has a servicing portfolio, and I got a call from them a couple of weeks ago saying, "Hey, our portfolio is running off. We can't stop it." And the bottom line is it's going to be tough because people are getting shopped. They're getting solicited, as you said. There's a lot of tools for not only the LO that originated that loan, but other lenders that have information to public data. So it's a totally different world out there, and you have to kind of keep up with all those changes.
It's a great point. We talk about refi boom and great year and, margins and volume all through the roof, but there is that other side to it, right? When you have a refinance boom, loans that are being refinanced are assets that somebody is holding on the books. And, it's a good reason to get into servicing because it kind of acts as a natural hedge, right? Volume is slow, rates are going up, the value of your servicing goes up, it stays on the books longer. But you get in one of these refi booms and you're a big servicer, that runoff piece, depending on how you're valuing servicing when it's going on the books, it could be a pretty significant impact for the negative.
Definitely, because you're looking at that servicing value of what's the prepayment speed, right? What is a 30-year going to pay off in 12 years or 15 years? Is a 15 going to pay off in 12 or is it going to pay off in 8? Dramatically affects the dynamic, but it's been a trend that we've seen for the last couple of years. I think people are much more savvy. I had a conversation with our finance folks. We talked about the subject, and I think the people that just bought or just refinanced in the last 12 to 24 months are much more savvy about it than the people maybe you've had the loan for 5 or 6 years because they don't keep up with the news or nobody's soliciting. So it's an overall marketing thing that you really need to incorporate into your sales part of how you're going to protect your pipeline, not your pipeline, but your portfolio, your previous customers, your servicing portfolio, health for others. There's a lot of dynamics there because if you don't do it, somebody else will.
That's a great point. I think, the loans on the books today, those borrowers, generally speaking, younger, more savvy. There's access to much more information, including what interest rates are. I remember like 10, 12 years ago, like regularly, and rates were low then too, but regularly talking to people like, oh my God, your rate is still like 4%. You haven't refinanced yet. It seems like And I think the pandemic was a big part of that. And a big part of the refi boom last year. Everyone was just home on their laptop, on their computer, on their phone. And, they had a lot of time to research if it was made sense to refinance or not.
For sure. Absolutely. It's again, and it's what they hear, right? It's what people hear on the news or what their circle of influence is. If your neighbor says, "Hey, I just refinanced," that makes you think about it. Or if you get that postcard in the mail, that looks like it came from your servicer, but it really wasn't. As I said, data is a powerful tool out there, and some people use it better than others.
Very well said. Some other news that's broke. Wall Street Journal wrote a pretty interesting piece a few days ago about FICO in general. That FICO's hold on the credit scoring market could be slipping. Just noting that non-mortgage products and a lot of banks like WesBanco that maybe hold some loans in the portfolio that they're using their own modeling in place of completely or as a supplement to FICO score. Been a lot of talk over the last couple of years that FICO could be kind of inherently biased in that good credit-worthy borrowers without traditional credit kind of penalized. Your thoughts? I know you guys do a little bit of portfolio lending. Are you guys how do you look at that issue, and how do you see the issue in general?
Well, I think the issue in general is going to be a hot topic because I think, to your point, Rich, there were conversations: was the FICO score fair to everyone? From you maybe not have a credit, a lot of credit, but maybe you have utilities, rent. So I think there's talk about bringing that into the fold. There's talks about new models. Saw the article that you talked about in the Wall Street, and a lot of banks have adapted that for consumer products in particular. We as a company have not done it. I think we're going to kind of look at it as time goes on. But I think the traditional way, hey, you get three repositories, you use the middle score. I think that could change over time. I know Fannie and Freddie had done a lot of studies on that last year. They kind of tabled it. But I think when we talk about equality and credit and access to credit markets, that is going to be a big topic because of how some people use credit and some people don't. And I think it's something we have to kind of keep an eye on. But that was a very interesting article you talked about in the Wall Street, that, especially on the consumer side. And there's a lot of variations to some of these credit models as well, the end files versus the full repository. So people are starting to get educated on that and ask a lot of questions.
And I know Fannie and Freddie forever, forever have been very outwardly supportive of, the premise of using alternative credit scores. I really feel like that is something you could see under the new leadership at FHFA. If it's Vantage Score or other types of, non-traditional credit scoring, something we could see going forward, and certainly something to keep an eye on. So
totally agree.
Other news, one of TMC's preferred partners, Blend, goes public last week at a $4.6 billion valuation. Crazy to me. I remember, 5-6 years ago, meeting Nima and a couple other guys from Blend. They were just getting going and had, grand plans, but have done a good job building their company. But really is amazing just the multiplier valuations of technology companies today, inside and outside the mortgage industry. Some have far exceeded those wild initial valuations. A lot have not. Your thoughts in general about just mortgage tech, Blend going public, and just how you see that space kind of evolving in the short to medium future here.
Well, I think, we talked about before, data is going to be important. Technology, less touches, more efficiencies. It's one of the themes that you've had in your surveys that have come out. And, people are looking at, hey, I've got to get better. I've got to get faster. I got to touch this file less. And I think when these companies go public like the Blend, it gives them a lot more capital to work with. It gets their research and development. There for a long time, we in the industry had a couple of the large players that were supplying a lot of the technology. Now all of a sudden, those two large players have more competition. Blend, a couple of the other ones that have went public are going to go public. So I think you're going to see consolidation in that industry as some of the bigger ones maybe buy some of the smaller ones and have some technology they want. But I think it's going to be a continual improvement. And kind of what I'll tie that into is an article I read yesterday about where there's a lot of real estate, the big conglomerates, the tech real estate companies that are competing with the traditional real estate companies, and they want to attract the buyer. And the whole gist of this article is they not only have to do the real estate transaction, but they need to do the appraisal piece. They have to do the lending piece, and they need to do the title piece. So how are they going to do that? It's going to be technology. It's going to be a one-stop shop. And how can you make that whole process seamless and automated? I think it's one of those things that we all will deal with here in the future and get more efficient. Like you, Rich, I've been doing this a long time, and we've seen the trends, kind of come and go. But the technology piece and being more efficient is probably the most important piece that we have right now. People do not like to continually supply information. They it's I want it now. So if you apply today, how quick can I close, or how quick can I get approved? And the traditional way of what we did in the past isn't going to work. And this just gives the companies like Blend and some of the others a real great avenue to approach. And I think they've got a great reputation how they're going to integrate with other systems.
Yeah, absolutely. It's such an important part of what's going on in the mortgage industry right now. I think to your point, every single lender, a more touchless process and implementing next level tech is right at the top of the list of their biggest concerns right now. I think, in general, I think mortgage lenders, myself included, feel like if you would have asked where tech would be in our industry 2 years ago, it's probably not where we thought it would be. Like, at least the effective and practical application of some of the real automated technologies, but we're seeing it through our tech fund. It's coming, it's down the pike. And one thing we hear from our lenders a lot that I would love to get your opinion on is just the net result of this last year was obviously, incredible amount of volume. Lenders had to staff up to some degree. Some went out like, drunken sailors and hired everybody out there in the marketplace. And others took a more practical approach that maybe made last year tougher. But now on the other side, maybe not some of the issues, but I think for all lenders, it drove up the cost basis of operational employees a little bit. This new tech is not expensive. So I think one thing we hear a lot from our lenders is just the desire to bring in young entry level, kind of train yourself talent, just because one, to lower the cost basis, to be able to cross-train staff, and two, those types of employees more likely to work more seamlessly alongside next level tech than that 30, 40-year processor or underwriter. Your thoughts?
Totally agree with it, Rich. We've talked about the last 3 to 5 years, what the average age of a loan officer is, what the average age of a realtor is, the whole gambit. So we've embraced trying to bring in some new people. We've got some training programs from them, because it's tough to get people in and get them orientated. There's been companies that have good training programs, and I was on a call yesterday where we're trying a little bit different approach on that. And you're right. I think the younger generation will embrace the technology more. And to your point, I think some of the things that have happened in improving technology, you may not have seen it per se if you're on the front lines, but I think if you're on the back lines, you've seen some of that efficiency. I think from, as you mentioned, the cost to originate, or what it took to pay a loan officer with some of the commission plans, and what it took to recruit some of the ops people with new salaries, bonuses, overtime, the whole bit. If we see that level out, people are going to have to look for that efficiency of how do I maintain the cost, because we are a production unit at the end of the day, and these technology rules are trying to make it seamless. As I said, do more automated and less touches. You may not let people go, but you're not going to have to hire as many people. Yeah. That's the approach that we're taking. We're not looking to eliminate positions. We're looking to say, hey, we're going to keep growing, but now you've got these tasks that you don't have to worry about. It's automated, or it's being done for you, and therefore you can handle more of a pipeline or underwrite more files, or whatever the case may be.
Very well said. This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative, this week joined by WesBanco's EVP over residential lending, Ed Hensley. We've got about 5 minutes left with Ed. And Ed, there's a couple additional topics I would love to get your perspective on: home building and cybersecurity. Spending your career working for some very prominent banks. Let's start with home building. The CEO of the National Association of Home Builders last week testified before Congress, basically just pleading for some help to help their members, their constituents, the home builders, kind of address this supply issue in America and the underbuilt home picture that we all know is out there, asking them to help fix the building material supply chain issues and some tax credits that could use tinkering and current home ownership tax incentives, making it maybe a little bit more cost effective for Americans to build homes. WesBanco does business 6-7 states, Midwest, East. How do you probably are talking to home builders and have your finger on the pulse of this issue. What are you seeing just on your day-to-day trials and tribs with the home builders and the new construction topic in general?
Rich, you mentioned one thing that we were actually asked by the Fed about 2 months ago, maybe 2.5 months ago: supply chain interruption. That's where it started. Because things happen with COVID, mills shut down, suppliers were coming imported, all of a sudden are locked up in ports and things like that. So I think that's a number one issue, is the supply chain. And that crosses over into other industries. We were actually asked by the Fed to feed back on that on a weekly, monthly basis of what we were hearing. So we've seen that. I think another issue, we know about lumber went up 300%. Now it's kind of backed off those highs. My understanding is the mills are kind of out there. But then there's this labor shortage. How, they're facing the same labor shortage as everybody else is. Are they going to do trade schools? Are they going to get some tax credits, to your point, which I think would be good for the industry? Because if they can't get qualified people to build these houses, they can't, even when the supply chain straightens out. So we're starting to see some movement in the supply chain, not only in the home building, but other industries. But that was the number one concern, over the last 2-3 months. Labor's been a big issue. I think, to the point of tax credits and some things like that. Time will tell what the government wants to do on that. But that's the things that we hear on most of our builders. The buyers want to buy. Some builders put moratoriums on, as I'm sure you've heard in the other calls. We've seen that sort of lighten up. But if you drive around different subdivisions, all of a sudden now you see that they've slowed down on how they build. And that's concerning for us, of what's that going to look like as we, if you're a cold weather state, what does that, mean come December, January, when we start getting really cold? So we'll kind of keep an eye on that. And, that's one of the legislative issues that's important.
And then moving on to just cybersecurity in general, been in the news as of late. Some title services companies that have had some breaches. Again, working for a financial institution, it was my past. That's obviously a top of mind issue to any and all financial institutions. How you guys looking at just the cybersecurity issue in general, bank wide and on the mortgage side right now?
Well, Rich, we take it extremely, extremely serious. And I will share with you that over the last 2 weeks, we were attacked. We were attacked from 4 foreign countries. And they tried to get into what we'll call public domains, people that had a public profile, i.e. LOs, i.e. our trust department. And they would try to take their email or their logon credentials and guess at what their passwords would be, and they would launch this attack where they can, continually trying to guess that. We caught it. We shut it down. We were lucky. I won't say we're lucky. Maybe our tech, we were prepared. We have seen where there was an entity out of the country that tried to duplicate our website, and it looked pretty darn good. And if you typed in one letter wrong, you could wind up on their site. So, we would encourage, no matter how big you are or how small you are, you have the best cybersecurity and technology in place to prevent those attacks, because ransomware is happening. Rich, you mentioned the title. Haven't had an update yet this week, but we understand there were closings that were affected by that, because that was a cloud service that a lot of the title providers used, and I think they had some backup plans. But it's out there. It's real. I don't expect it to cure itself anytime soon. You hear about the big ones, but any company is vulnerable for it. I mean, it's something you have to be very, very diligent. If you're a financial institution or you're a company that's got people's financial information, they're going to try to get it. These are sophisticated people. They're sophisticated groups. And as I said, they're in multiple countries. It's not just located to one. So having good technology to prevent it, good technology people that know what to do, and being able to shut it down before it takes hold are all keys.
Ed, always enjoy the conversation, getting your perspective on our industry. Really appreciate you joining me this week.
Rich, my pleasure. Been good to catch up again. Thank you.
Absolutely. And to our listeners/viewers, thanks as always for spending 30 minutes with us every Tuesday at 2 p.m. Eastern. I'll be here same time, same place next week for the last week in Mortgage Today. And as always, we will upload this episode to our YouTube channel and release it as a podcast, where I know a lot of you listen or view as well. Until next week, have a great rest of the week, everyone. Thanks again, Ed.
Thanks, Rich.
Take care.